Welcome to this session of Introduction to Accounting and Accounting Systems. Today, we're going to learn about the basics of accounts. How is accountancy important in day-to-day activities of a financial firm? Today, we're going to focus on the basics of accounts. What are the accounting systems? What are the accounting conventions? And what are the golden rules of accountancy? Let's get started. Now, what do you understand by the term accounting? Accounting is an art and science of providing meaningful information about the financial activities of a company, a business, or a firm. It helps in maintaining the financial records of the day-to-day activities which happens in a business. Now let's look into what are the business transactions. The economic activity of exchange of goods or services in exchange for money or money's worth is called as a transaction. What is a transaction? The economic activity of exchange of goods or services in exchange for money or money's worth is called as transaction. The entity that carries out transaction, a firm which carries out transaction, is called as a business. It can be on the aspects of buying or selling of goods and services by making a payment. Next, we're going to look into what are the important terminologies when it comes to accounting, which is very, very important. Proprietor or a owner, the person who commences a business and undertakes the risk of carrying out the various business transactions is called as a owner. Is nothing but who owns a business. Next is capital. What is capital? The initial invested money by the owner is called as a capital. The initial money contributed by the owner or a proprietor to start a business is called as a capital. Next, drawings. The money withdrawn by the owner for personal use is called as drawings. Next, assets. The resources needed by a business to function effectively. Example, plant and machinery plays an important role. Furniture is an example of an asset. Next comes the liability. The obligations of a business are called as liability. Sales, the exchange of product or service for money is called as sales. A company wants to sell furniture. So when furniture goes out, what do we get in? Money comes in. What comes in? What goes out? Purchase, the acquisition of a product or a service for money. So these are the important terminologies of accounting. One is proprietor, capital, drawings, assets, liability, sales, and purchases. Next comes revenue. The income. What is a revenue? The income received by a firm from its business activity. Income is called as a revenue. Expenses. What are expenses? The cost incurred by a firm due to its business activity. Revenue is what we get, what comes in, income, what comes in, expenses, money goes out of the business. Next comes profit. When revenue is more than a firm's expenses, the condition is called as profit. Next, loss. When expenses of a firm is more than its income, the condition is called as a loss. So what are these important terminologies of accounting? Are revenue, expenses, profit, losses, owners, capital, drawings, sales, purchase, assets, and liabilities. These are a very, very important terminologies you'll have to remember when it comes to accounts. Let's look into what is accounts. Like I said at the beginning, accounts is the art and science. For what? For recording, classifying, summarizing, interpreting the transactions in a business. Why do we call it as account as an art? Presentation matters in accounts. Why is it called as science? It has its own laws and principles. Accounts has its own laws and principles. I hope now you got why accounts is called as an art and science. Presentation is important and accounts has its own rules and regulations. In front of your screen, I have just put up on what are the definitions of accounting. The process of identifying, measuring, and communicating what? Economic information to permit informed judgments and decisions by users of informations. This definition was given by your AAA. What is AAA? American Accounting Association. Now, let's look into what are the few objectives of accounting. Why does a business need accounting? Why? Systematic record of transactions, determine profitability based on incomes and expenses, determine financial position in terms of assets and liabilities. So these are the few objectives of accounting. When we are moving forward with the accounting history, evolution traced accountancy 7,000 years back. So these are the few histories of accounting. In India, Chanakya wrote Arthashastra with details of books of accounts. Roman Empire developed account audit system. So these are the few points or bullets of history I've put across in front of you. Now there are few branches of accounting. What are the branches of accounting? Financial accounting, cost accounting, management accounting. Let's go one by one. Under financial accounting, what does it deal with? It deals with preparation of books of accounts. Chartered accountant comes here. Next, we're moving into cost accounting. Study of cost and methods to reduce them. Cost accountant comes here. Last, management accounting. Analyzing account information to take meaningful business decisions. And management accounting comes here. So these are the branches of accounting. What are they? Financial accounting, cost accounting, and management accounting. And there is a few relationship between the branches of accounting, which plays a very big role. To make transaction, the decision making plays an important role. Next, we're going to talk about users of accounting information. There are two types of users, internal users and external users. Who are these internal users? Located within the organization. They have access to an extensive information within the organization. Example, your employees, directors, levels of managers. Moving on to the external users, it is located outside the organization. They have a very, very limited information because they're not internal, they're external. Can you give me an example? Can you think of an example? It can be governments, creditors, and so on. So these are the users of accounting information. Who are they? Internal as well as external users. Next, we're going to look into what are the limitations of accounting. Records only monetary transaction. It's historical in nature. No global practices or policies in place. Limited scope for future assessment. It requires a qualified professional. Again, there are two types of accounting systems. We have single entry system and double entry system. Let's see what is a single entry system. It considers only one effect of the transactions. Unscientific system of accounting, incomplete system of accounting. It is only used by small traders of a firm. It does not need a qualified dedicated resources. But in double entry system, it considers both sides of the transactions. Scientific system of accounting, complete system of accounting. It is used by the large firms. Here in double entry system, need a qualified and dedicated resources. So these are the accounting systems which have been divided into two parts. One is single entry system and second is the double entry system. Now, in accounting, there is a form of equation. There's a basic principles of accounting. There is a foundation of double entry system. There is a all-time equation, which is all about total asset is equal to capital plus the total liability. But for a company, total asset is equal to shareholders' equity plus the total liabilities. So these are the accounting equation which you are, viewing on the screen. Just have a look. Total of all the obligations of a business. Now we just spoke about assets. Now we're talking about liabilities. Total liabilities is equal to the long-term liabilities plus the current liabilities. Example of long-term liabilities, debentures, loans, current liabilities, bank overdraft, short-term loan, and so on. So these are the total, we just looked into accounting equation of total assets and total liabilities. Next, we're going to look into accounting equation on capital. What is it? Shareholders' equity is equal to share capital plus retained earnings. Share capital includes the resources contributed in return of the ownership of a business. Then again comes total assets is equal to fixed assets plus the current assets. What is fixed assets? Assets that are used for long-term use. It cannot be converted into cash quickly. What is an example? Land, machinery, and so on. What is a current assets? Assets that can consume within a short period of time. It can be converted to cash quickly. What is it? Can you give me an example? Stock and debtors. So these are the few accounting equations which we just went through. So by this, we are completing this session. In the following classes, we will follow on what are the accounting conventions, and we will look into what are the accounting concepts and what are the accounting conceptions. So accounting plays an important role in a business. To do accounts, you need to know the basic rule of accountancy. That's very, very important. Before moving ahead towards the problems, you'll have to know what is the rule of accountancy in personal account, in nominal account, and in real account. That's very important. So in the next session, in the next class, we will be talking about what are the accounting conventions and concepts. Until then, have a nice day. Thank you.